The Situation Room broadcasts every morning on SpiceFM around the country. We are online, SpiceFM KE, YouTube, Facebook, and Twitter for 1 hour, 8 a.m. to 9 a.m. We're also live on KTN Home. Good morning to our audience joining us on TV. This is your radio experience on TV. This hour, we want to discuss the issue of digital lenders. All right? And the chairman of the Digital Lenders Association of Kenya joins us this morning, Kevin Mutiso. Karibu sana.
Asante sana. Thank you for having me.
Welcome to Kenya's biggest conversation.
Asante.
Now, we've talked about you guys for a while, and we've been saying we will have them come here once we have exhausted everything that we want to say about you in your absence, so that when you come here, we don't repeat. We'll just be giving you platitudes, give you that seat. We call it the hot seat. It's just where you come and you're served very good breakfast. Don't worry, you'll see it soon. Citi, there was a story yesterday in the papers, and this was with regards to regulation of the digital lenders. This conversation has been taking place for a while. People first of all wondering, so companies have come and set up in the country, and then companies have reached out to people and said, you want some quick cash loan? All right. So here's the modalities. You can get access your money here and there. And then, ghafla bin vu, punde si punde, as Citi would say, the issue of CRB, the Credit Reference Bureau, started coming up. And people now started associating the digital lenders with being reported on the CRB and, just tarnishing a otherwise very good reputation. The only thing you haven't done is just repay a loan. I mean, come on, nitakulipa, what's your problem? And then now we got into conversation about regulation. We will get into regulation, Kevin. But let's first of all start by understanding your industry. So the digital lenders, who falls in this category of digital lenders, number one. And number two, what's the profile of your borrower or your customer?
Those are both great questions. So first, digital lending is the act of doing three things. I've been quoted before saying that digital lending is the greatest invention ever. And the reason I think it is because we've been able to do something quite remarkable, which is we're able to do KYC, which is know your customer, which basically means we're able to know that it's Eric Latif that is downloading the app, filling in the form, and then, of course, borrowing. The second thing we've been able to do is credit scoring. So we're able to take data from different places, CRB, M-Pesa, phone data, etc., and say that Eric is a good potential customer. If we gave him 5,000 shillings, he would use this money and repay us back. And then finally, of course, disbursements, which is sort of the evolution of M-Pesa. M-Pesa first was a peer-to-peer money transfer system, then became a business to customer, then went to business, and now we could do business to customer after doing the first two processes. Now, the reason it's a remarkable feat is because before us, the cheapest loan you could issue was 100,000 shillings, because the cost of KYC and the cost of credit scoring had all these different manual processes that sort of added cost. Now you could do it on a digital platform and, of course, then loan. The governor of the central bank loves to say digital is a channel. So that's also one of the key things. It's just a channel. We haven't really redefined what lending is. It's still the same, checking for fraud, checking for willingness to repay, and checking for ability to repay. Now, who's the profile of customer? This is another huge misconception. When we lend, we typically look for what we call the informal sector entrepreneur. So the mamambogas, the boda-bodas, the cart pullers, you name it. Unfortunately, in that bag, because we are a young industry, we've sort of netted some young people. Some of us have created this problem called over-indebtedness, which I'm sure we'll talk about. But that's typically the profile of customer we deal with.
So the person that you target is the informal sector entrepreneur.
Yes.
And who is that? Who's an informal sector entrepreneur?
An informal sector entrepreneur is one who does business. So there's a form of trade, but isn't formalized. So they don't have a business permit, they don't have KRA PIN, they don't have a bank account, but they're involved in trade. So a good example would be a mama mboga, right, on the side of the street. She puts all her wares on the street corner. But she doesn't have an ETR receipt. She doesn't have a marketing plaque, none of that. So she's an informal business. Yeah.
So we know there are companies that are in the digital lending that are not banks. And then we also know the banks that have products where you can borrow through digital. Are they also part of digital lenders?
No, so the Digital Lenders Association of Kenya is a membership of 21 digital lenders. We represent what we call the unregulated side. The regulated side are the banks, so they come under the CBK Act and are regulated and have a whole process. We didn't have anything to follow.
Is there a reason why you didn't?
Well, the Money Lenders Act was repealed, I think, in the late or early 90s. And so in Kenya, if you're a non-deposit taking institution, you could lend. And the premise was that why should I enter between a contract between two parties if the money is mine and I'm lending it to you? Why should there be a regulation in between that? The challenge now is that because digital lending has become so
That
common,
word.
that word, so common, we are now impacting 6, 7, 8 million people on a monthly average. So now it has become a serious issue, and we need to now start sort of putting some parameters.
So you fully support the initiative that the central bank is proposing to take?
We have been actually calling for some form of regulation since 2018. And actually that is why the Digital Lenders Association of Kenya was formed. For us, as we grow, what matters now is predictability, right? As our businesses grow, we need to be able to plan 5, 10 years into the future, because now our business models have matured. And without regulation, there's an element of risk that is now in the marketplace that we need to solve as businesses as well.
Okay. You said initially that this was set up for the informal sector, right? Those who don't have the documentation, as it were.
We call them thin file.
Thin file? Yes. Okay. But
You will have to explain the thing.
Oh, for sure. I'll come to that.
Yes.
But we see that there has been a proliferation of people taking out these loans who are not specifically in that category. And many would argue that you had more on the other side who were actually documented taking than the informal sector that you had previously mentioned. Why do you see that is the case?
Well, that's an interesting point. In Kenya and most of Africa, it's quasi, right? We are formalized, but we are not really formalized. What does that mean? You find that there are a lot of informal sector entrepreneurs who have a day job and work, at a factory or at KTN or at SpiceFM, and in the evenings or during the weekends, partake in a different entrepreneurial
Side hustle.
Yeah, side hustle. We call it. Kenyans even have a famous term for it in Swahili, and as a result, you find that we are both formal and informal in many respects, and particularly in urban centers.
Among the things that you said was, and we're going to discuss that, is initially you are targeting, as a business, your strategy is target those entrepreneurs in the informal sector, because they are trading, they need capital, they need operating capital. They will come to you, they'll borrow, they'll repay within a certain period because they are trading. And then you saw a proliferation of other people, let's say students, coming in and borrowing and then not being able to repay. But the first thing that you told us that digital lenders are able to do, which is the best thing that has ever happened, is that you have very robust KYC protocols. Those two do not sit together. If you know your customer, how do you not know that this is a student?
So that's, again, a very good point. And the best way to sort of give you context is think of it like a baby. So digital lending came into being as a result of various factors coming together.
A baby as in a toddler child.
A toddler child,
Okay,
yes.
go on.
So in 2007, we have this thing called M-Pesa.
Yep.
M-Pesa changes the game. And now what happens is that you've put a wallet or digital financial service in the hands of Kenyans. Number two, in 2013, the Credit Reference Bureau is enacted, is passed into law, and the regulations are then put out. So now we have what we call a credit information sharing framework. And then the third thing, obviously, was IPRS, the Government Registration Services. And then shortly thereafter, the government insisted that anyone who registers a SIM card anyone who owns a SIM card must go and register so that we now know whose SIM card belongs to who, the ID number, etc., etc., etc. Now, the first digital lenders outside the banking system came into play in 2014, right? And between 2014 and 2017, we were making a lot of mistakes. I'll give you an example. One of the key things we found out in my business, for example, was we were lending to bettors, people who were betting. So we were doing all the KYC, and our initial scoring parameters were letting bettors come through. But very quickly, we were able to identify that unique data piece that identifies a bettor, and we were able to cut it off. So to answer your question, the way credit scoring works is that it evolves. It's taking data and then using that data to understand your customer better. And the reality is we are still a young industry. We're only about 5 years old. So to the toddler analogy, now we are a 5-year-old child, still, and a little bit more advanced in terms of we can walk, we can talk, we can run, but we still haven't gotten to a point where we are, our systems are 100%.
Still can't put your arm around your head.
For example.
But what I often wonder about, useful as this particular enterprise is, how exactly do you deal with financial exposure? Because banks take deposits, banks have to have a certain liquidity ratio. What do you people do?
So we lend private capital. So we look at capital like a raw material. We price, the cost of that raw material into the pricing of the loan. So that's how we manage it. And then we go to the market, to the capital markets, and put out papers, or we use our own money, or we go to the bank who lends to us money to then on-lend.
As we talk about this, you've also mentioned that you impact or you reach out to about 7 to 8 million people every month. That's a huge number. How much are we talking about in that month?
Well, pre-COVID volumes of Digital Lenders Association of Kenya was about 4 billion shillings a month in loans. Since COVID began, we've had a couple of disruptions. The main one being a circular in April from the central bank denying us access to the Credit Reference Bureau. That significantly affected our credit scoring and other parts of our business model. And so the number is now between 1 to 3 billion, but there's no certainty. But pre-COVID, we were doing 4 billion. The bank lenders, however, pre-COVID, Mshwari was doing up to 250 million, 25 billion shillings in monthly loans. Yeah.
One of the reasons why a lot of folks enjoy the services that mobile lending offers is that it's quick. It's almost instant, and you're rarely denied. But one of the dangers being that I will borrow from Mutiso today in terms of a mobile app. I will borrow from CT to pay Mutiso, and then I will borrow from Eric to pay CT that will allow me to pay. So we've seen a lot of these reports in the last 6 months of people who can have up to 5, 6, 7 mobile loans operational at the same time and are going deeper into debt. Now, do you feel that the association has a responsibility in regulating this kind of behavior, or are you interested in the bottom line commercially when it comes to lending, getting your profit, and then you move on?
That's a fantastic question, and I'll tell you why. Over-indebtedness adds risk to my portfolio as a business, and so it isn't in my best interest to have an over-indebted customer. The reason over-indebtedness happens in this market is actually systemic. The challenge is we're not able to share data between lenders in real time. It is assumed that the CRB is real time. It actually is not. It actually works on 30-day cycles. And so because of that, if Eric takes a loan from me and then you take a loan and then he goes to take a loan from him, I will not be able to tell him that Eric took a loan from me in the morning until a month later. And that's a systemic issue. So what are we doing about it? We have put out proposals for a system called the Credit Fraud Prevention System, which will work in conjunction with the Credit Reference Bureau, which basically allows digital lenders like us who do short-term loans, because typically our loans are 7-day, 15-day, 30-day, max 90-day, who are not in that monthly cycle like the banks, to sort of share data around and lending data in a private secure way, to tell the other lender that don't give money to Eric, there's some risk if you do. Yeah. So it's a systemic issue. It's something that the association wants to solve as quickly as possible.
So are we talking about risk to the business, or are we talking about protecting the citizen who could then go into indebtedness?
It's both ways.
Okay.
It's both ways, because as I said, it doesn't make business sense for me as a business owner to give somebody money that they will not be able to pay. I'm going to lose that customer, right? I'm not uplifting the customer. And the best way to look at lenders is we actually provide fuel, right? Money is fuel into business. Consumer lending is another type of lending which isn't what digital lending is mostly about. And there's something else you said. We actually do not approve as many loans as you think. Yeah, we have over, I think, 24 million adults, and I think only 6 to 8 million, between 6 to 8 million have accessed a digital loan. And I'm imagining about 14 million have tried to apply.
What's a percentage of those that apply and don't get?
That's different from every lender, but like at our place, it's about 80% do not get. So we only approve 20% of applications.
And what's the absolute threshold that you're looking for? Because we still have, and I think it goes to your initial idea for starting this as mobile lenders. You have a huge percentage of the population right now who doesn't have access to credit, which is a big deal.
It's a big issue.
Right? So what is your threshold to say that person X comes today and tries over their mobile because they do not have the wherewithal to go to a bank and borrow 10,000 shillings, right? What are you looking for from an individual who comes and says, I need a little bit something to fuel my business today, to buy produce, to supply tomorrow?
So there are three main things in lending we look at: fraud, willingness to repay, and ability to repay. So fraud is the usual thing, right? What people tend to forget about lending is because we have money, everyone is trying to get something, right? So even the bad actors. So we have got very good security systems to sort of push and manage that fraud element. And by the way, fraud was a big issue in 2018. The industry lost up to 30 billion shillings that year.
Wow.
Yeah. So as I keep reminding people, we have not been making the super profits people think. We are still a young business. We are about to get into that phase. The second thing is willingness. Willingness is that thing where we are able to show that Eric has taken a loan and repaid it, right? It doesn't have to be my loan. It can be anyone's loan, but has taken a loan and repaid it. And that's why the Credit Reference Bureau is so important, because the Credit Reference Bureau takes away this thing we call fast loss risk, which is the most expensive risk when you're calculating somebody's risk, because if you don't know if they repay, right, you're really taking a risk by giving them that fast loan, right? So that's why that Credit Reference Bureau is important. And that's why if you read any literature around Credit Reference Bureaus, there's this thing called a trust layer it creates. And it really helps in low trust societies like ours. And then the third thing that we use is ability to repay, and this is cash flow. So we're looking at M-Pesa statements, bank statements, and anything that can give us some sense of your financial cash flow. And then from those three things, we're able to calculate now, okay, what's your limit? First, do we approve or reject? If you're approved, okay, then what's your limit? If there's a limit, and then we keep adding to the data sets as we go along. So if you pay me back, now you've gone up in the willingness to repay score, right? If your cash flow has improved because of my loan, you now move up also on the limit you're likely to get. And that's the That's the utopia.
Having a conversation with Kevin Mutiso. He is the chairman of the Digital Lenders Association of Kenya. Who are they? There's a new move to enter them into the ambits of regulation. Is it a good thing or is it a bad thing when you regulate the digital lenders, City?
Something that you mentioned that caught my attention, but it not just caught, it gripped my attention when you mentioned the amounts involved, 30 billion in terms of losses as a result of fraud. Tell us a little bit about the anatomy of what you refer to as fraud. What is it? How does it occur? How does the institution that you belong to end up losing a colossal sum such as that one to this one element, fraud?
Okay, so it wasn't one institution, it was a whole industry. And fraud usually comes in many forms. I'll give you the reason why fraud happens. It's the main risk we have to manage. And the reason is because we assume to have money, you have every type of person trying to get in, no matter how. So as I was telling your colleague that since time immemorial,
My name is Ndu.
Ndu, it's a hard name to pronounce.
It's easy. You just want to
NDU.
NDU, okay, Ndu.
put your back into it. You'll be okay.
Ndu. As I was telling Ndu earlier, is that even the old bankers of the 1100s, 1200s had some of the best safes and the best vaults in those days to manage fraud. So fast forward to the 21st century, fraud comes in different ways. One of the key fraud, as you said, looks like is identity fraud. And I'm sure you've seen a lot of cases where you've seen old mamas in particular complaining that their names are on the CRB, they never took a loan.
Yeah.
But they have a 2,000 to 20,000 outstanding, and they're wondering where it came from. That's identity fraud. Now that happens because of digitization, because we're using ID numbers, we're using Safaricom lines, or rather telco lines, to identify these customers, and so identity is a big issue. So that's the other one, the main one. The second one is around gaming the credit scoring. Right, so you've got geniuses sitting in a room somewhere, and it's usually very coordinated. People always assume it's one guy in a room somewhere. It's actually quite coordinated. They're trying to understand how your algorithms work and how you're setting limits and who gets the highest limit, why they get that high limit, and then on one day they come and they attack and they take. They take.
So they come and apply for a loan.
Yes.
And they game your system such that you score them very highly.
Yes.
They will surely get the money.
Yes. It's called loan stacking.
Right.
So you stack to the top of the limit on several numbers, and then you just default. Right. Those two, by the way, we found solutions around that. That was a major problem, as I said, in 2018. Today, not so much of a problem. And then the third one, obviously, is the actual movement of the funds. Right? If you've seen any movie today, you've seen robberies taking place. These jackers, they jump onto the car and then they're trying to do whatever.
Yep.
So think about it the same way. The M-Pesa connection, the bank connection, our various solutions have connections. And so there are people who are also trying to sort of ram and break into those connections. Again, because we are a collaborative industry, this is the other good thing about financial services. We work together. We realize the importance of being in unity. We actually have solved some major issues that were there in 2018 around each of those three. And now we manage the fraud risk pretty well now.
But tell me, for what you're saying to happen, there's always been this speculation that the people who work in that industry are complicit.
That it's an inside job.
Precisely.
Well, that's a valid point, but fraud is all encompassing. It could be inside, it could be outside.
It's still fraud.
It's still fraud. So I was describing the types of fraud. Typically, you hope that it isn't an inside job. And you hope and pray and you hope that your HR processes work. But sometimes that's not the case.
When you say, for example, you've been pushing as the Digital Lenders Association for some form of regulation, Is it some of the things that you want, for example, saying that there should be minimums for you to operate as a digital lender? This is what you have as SOPs for addressing fraud or for curbing fraud or preventing fraud, such kind of things, like the kind of systems that you need to invest in.
Well, fraud is a business risk, and so usually in a typical capitalistic market, that should be a business issue. So it shouldn't be a regulatory issue. What we hope is that any business that's coming into this game should understand that fraud is the big risk, and if they don't mitigate against it, they won't be in business for too long.
They will suffer.
Yeah.
The other concern around this has been on privacy of data. And you talked about the KYCs and how you do the credit scoring. You have access to my data with the Credit Reference Bureau. You get access to my data from the telcos. You have access to my data from the fact that I applied and my behavior within a system, your system. Now, that is a lot of information about me that you have. When I go to apply for a loan at the bank, they ask me to bring the information that they want. They have my PIN number, they have my, before the CRBs, they have my PIN number, they have my ID, they have how much I've been saving with them. And then they tell me, bring this and the other, bring your statements from KPLC or any bill that you've been paying, bring such. You have access to it even without asking me.
No, we have to. In fact, that's the Data Privacy Act 2019 is very clear on how we should manage customer data. Right? And so we cannot take that data and use that data without your consent. In fact, the term is express consent. So that's a very important thing.
So how is this played out?
So usually when you download one of our solutions, you shall see a series of things. One is either terms and conditions. You will also be asked to fill in a form. And in addition to that, you usually see a screen that explains some basic data that will be required. And then you say yes to that data being pulled from the various data sources. And we use that digital signature as confirmation that you have expressly consented to us taking your M-Pesa data, taking your KYC data, and taking your what we call metadata of your smartphone to do the credit scoring. Now, you said something very interesting, that in the old days, the bank would ask you for very specific things. Now, my pushback to you would be, go and see who will give you the loan first, right? It is the innovation of taking and pulling that data, scoring it quickly, and then giving you a decision that has changed the game.
True.
If you went to the bank today, you'd wait from anything between 2 to 3 months. And if you've been in business in Africa and Kenya, you also need to know the bank manager, right?
It helps.
It helps. Right?
Yeah, some 15 billion.
Touché.
So my point is this. The data protection piece has been solved by policy. It now needs to be enforced, right? And the Office of the Data Commissioner is actually making some tremendous efforts to try and figure out how best to manage people contravening the law.
All right.
Yeah.
You know, the other challenge that's always there is the fine print. So the terms and conditions is this long document in small font that has so many things in legal jargon. And all you're required is check the box and submit. And then you've said you bring another form and another form. Those are 3 things that I'm supposed to just...
And
Boss,
Eric,
I want 5,000, Bob.
It's not just small font. The language.
Yes.
Legalese.
It's legalese.
God Almighty.
And all you're required to do is simple. I mean, just check the box, press the button, submit. Now, do you have a responsibility to make sure that people who access your services understand beyond just that seeing of a form and signing, understand what exactly they've signed?
So that's a valid point. In the Digital Lenders Association of Kenya, we have the Code of Conduct. And the Code of Conduct clearly states that legalese should be avoided and we should use simple language, right? In fact, even when we were making submissions to on both bills, the CBK Amendment Bill 2021, we proposed consumer protection guidelines, and in those guidelines we proposed marketing guidelines, right? And in those marketing guidelines, what we were saying, let's make sure we put price, let's make sure we put the key terms of every loan, in big, bold font. And let's even use examples such as South Africa that has a law that says that if Ndu takes a loan in a language and signed for a loan in a language that she can prove she does not understand, that contract shall be deemed voided. Right? So we even presented global solutions to these kinds of problems, and we submitted that to the parliamentary committee, and then they gave their recommendations thereafter.
Okay, we're looking at securities now, and we're talking about regulation. Being regulated, not necessarily in a manner like other financial institutions such as banks. Security plays a big role here. And we've known that in the financial sector, people have played very hard or tried very hard to make sure that security is up to scratch, so that people are not, running away with your money. In terms of security that you've talked about now, how assured can people be? How assured can the market be that this security that has brought about some of this loss is something that can be dealt with?
If you're talking about security from the fraud point of view, that's an evolving process. I always like to use the analogy of a house, right? In your house, you have a gate, and then if somebody breaks in, you then put grills, and then if somebody breaks in, you then put in an alarm system. And then at some point, it becomes very difficult for anyone to get in. And the only way people can get in is if they really, really want to. So most of us, our systems are at that point. They have fail-safes, and so it's very difficult. It's actually next to impossible to get in now. If you're talking about data privacy, that is also something that we protect because data is actually our balance sheet. It's what makes our business unique from each other. It's our secret sauce. It's our intellectual property. So we also protect that, if not as much as any financial portal. Yeah.
So for somebody who wants to, and all of this is taken from, experiences that people have written about, have now been collated in media stories that we've read. So if somebody tries to borrow the first time and is told, no, thank you, try again, you've not been able to succeed, and you're in the business of loaning out this money and you've turned away this individual because of 1, 2, 3, what are then they supposed to do to be able to come back and try again, if not having been put off by the first response?
Usually, if you've been rejected by one of the solutions, it's a myriad of reasons. The most common reason is affordability and proof of willingness to repay. As I said earlier, we live in a low-trust society, so willingness to repay is one of those algorithms that we've really worked on to calculate, will you really pay us back? Right? And if we don't pass that threshold of comfort, we typically do not therefore lend. And so what I'd advise anyone is try again and again and again, and then improve any of your willingness and ability to repay metrics. So if you have an outstanding loan at the CRB that's marked as default, right? Because the other confusion is that CRB is a blacklist. It's actually just a list of your credit behavior, good or bad. If you have any loan marked as default, just figure that out. Make sure that it's moved back into current. If you have any outstanding amounts that are significant, because that's the other thing that when measuring willingness, say you have a loan of 200,000 shillings and we can see you have days in arrears, what we call days in arrears, and you want an additional 10,000 shillings, it's a very difficult decision to make as a business to lend to somebody who's already struggling to pay something else and it's already visible. On the flip side, you have ability to repay. So if you've come to one of our solutions and we can see, and I've seen this several times, by the way, your average M-Pesa transactions is 40 shillings a day or 50 shillings a day. I'm not saying that you don't do business on M-Pesa, but you need to up those volumes so that we can see that cash flow movement. Right? Because if there's no cash flow, how are you going to pay us back?
Not liquid.
Yeah.
You mentioned something about data informing you about the sort of clients you have, and that there was a time when a good portion of the people who were borrowing from you were people who were involved in the betting industry.
who are bettors.
They bet.
Yes.
And how then did you source this information? Is it from their M-Pesa statements? Is it from the frequency with which they borrow? How do you arrive at this information? How do you know that this person is not lending to his relatives?
It's a gabra.
And is a
It's usually a set of data sets. Well, I'll give you an interesting insight. One of the key things you could tell is before a big game, you'd see a volume, an upsurge of requests, right? And so you could now start making deductions. And then you start testing those deductions, and then you figure out. I'll give you another very interesting case. We realized that between 6 a.m. and 6 p.m., our portfolio would perform better than the portfolio of 6 p.m. to 6 a.m., right? Why? So we investigated, and now that's our secret sauce. But what we did to change the metric is we changed the times when you could access loans from us. And what we realized is that the people who really needed those loans adjusted their behavior and came before we. So what we did is we shut down lending, like a physical bank. We just said no lending on the digital platform. Kuja Kesho, yes, exactly. And what happened is the good customers, the portfolio, the customers that we had noted would pay back anywhere between 6 p.m. and 6 a.m. would come before 6 p.m. to borrow, or start very early the next day at 6 a.m. to borrow. And so we lost all those people who might have been borrowing for other reasons over the night time. And that improved our portfolio. And that's an example of how we use data to improve our scoring. Yeah.
Something else about credit scoring. So CRB Act comes into effect was enacted in 2013. Have been a conversation over a long time. When your credit information is given and, is stored in one hub, then it can be used very well by the financial institutions to know who to lend to, but also by the customers. That side of the customers is what I still haven't seen in terms of if I have a positive credit score, what advantage apart from just qualifying for a loan do I get? Do I get a cheaper interest rate? I've never heard anywhere where they say, just because you have a positive credit score, then instead of giving you a list loan at 16%, we actually can now start negotiating at 8%.
Actually, if you go to the Digital Lenders Association website, all of us have what we call risk-based pricing models, right? So, in fact, if you look at the big lenders in this market, in the unregulated space, whenever you look at their products, they're always in ranges. So you'll find 8 to 19%, 6 to 15%, 12 to 30%. The reason those ranges exist is because as your risk profile becomes safer, right, your interest rate comes down. So that is already happening. Now, the central bank governor has actually been pushing for this. He wants us to move towards a risk-based pricing model. And if you think about that, that's actually brilliant, because what that means is that the market will be pricing money for different businesses at the risk level that they're at. So you'll have very, what you call steady portfolio. So you'll have a very good portfolio, and then on the customer side, you'll have customers benefiting from good repayment behavior.
Is it going to open up an opportunity where I know my credit score so I can negotiate?
Of course.
Because this one sounds like you're the one who's determining, you fall in the 7.5%, or you fall in the 15%. Can I come and tell you, no, I don't think I'm in the 7.5%. If you can't
that's
give me
where
this,
we're going to. In a year, 2 years, 3 years, the better your credit score, I bet you the better the places you will live, the better the jobs you will get, the better the mortgage rate you'll be getting.
In how many years?
2-3 years. The CRB system, the Credit Reference Bureau framework in Kenya, is number 1 in Africa, number 4 in the world. Right? It's a national asset. And if we continue using it as it's meant to be used, it's actually going to improve the businesses across the country.
Okay. That experience of being able to negotiate interest terms with a financial institution, I have experience in a bank. If you have one of these fancy accounts which they call Premier or Advantage or the other,
Platinum card.
or something of that sort.
You're given biscuits when you go to the bank.
They even give
cookies.
they even give you tea, okay, with milk.
Now, the rest of us queue.
No, there is just forget queuing. Sit
That's not true.
sit and play with your phone as you wait for your number to be
for your
called.
number.
Literally.
Yes.
I'm surprised you're all going to the bank still. No, we all have
Oh,
digital
no.
platforms.
I'm not talking on their behalf. I'm talking on my own behalf. I'm the going to the bank type. Okay.
You're now a minority, though, Mr. Moga.
I understand fully. Isn't it a nice thing to be?
So I'm
CT
surprised you're
wants
still
to
finding.
see.
I'm surprised you're
CT
still
is,
finding queues.
CT is
CT
he
wants to be shown his money.
Me, I am a C-touch person. This thing of M-Pesa is all good and well, but I want to see money in my pocket. So I say, oh,
Yes.
now, yes, that negotiation takes place when you have one of those accounts. But you know what they do? The best they'll do for you, 1%. Now, 1% is a huge percent
Yep.
if you are borrowing in the hundreds of millions.
Yep.
If you're borrowing 20,000, you tell them, why don't you just charge what you're charging before? Because you're giving the impression you're doing me a favor, but this 1% isn't doing me very much good.
Okay.
What you're saying
I
in
disagree, though.
what you're saying in theory, I expect you to disagree. That's why I'm saying it. What you're saying in theory ought to work. Okay? But how long have we had a credit reference bureau in this country?
8 years.
Precisely. Now, in 8 years, you're still telling us in 4 more years.
Standard 2.
Yes.
No,
Here you're repeating class.
No,
Yes.
no. Actually, remember, we still have to populate the Credit Reference Bureau. So in 2013, we had 0 people in the Credit Reference Bureau. Yeah. Fast forward to 2015, we had 300,000 people in the Credit Bureau. 2019, we're now getting to 4 million people. Right. Today, we're at 14 million people. Right. We're 50 million Kenyans.
And your industry has contributed to it significantly.
Of course.
Yeah, I agree.
Yes.
Because the percentage of Kenyans who actually pursue banking services are a minuscule number.
It's an interesting conversation that we're having. To respond to this, let's first say goodbye to our audience on KTN Home. 5 minutes to 9. Having a conversation with Kevin Mutiso, chairman of the Digital Lenders Association of Kenya. As we take this break, just plug in. So, which organization specifically do you represent? I know you are the president of the overall, but which one is yours?
So we have an app called Oye, which is specifically for the Boda ecosystem.
Oye.
Oye, O-Y-E.
Okay.
We're currently running pilots around various petrol stations in Nairobi. And the idea there is we're giving... The way we are acquiring the customer is novel. We're giving, if you fuel at a petrol station as a boda, we give you insurance for free that covers medical, covers last expense in the event of an accident, and covers permanent disability.
Give a man an opportunity just to plug Kidogo. He takes an entire minute.
So,
This
yeah.
conversation continues on SpiceFM around the country. If you're in Nairobi, Mombasa, Kisumu, Nakuru, Eldoret,
Well, because I think Boda solves several problems. I think it solves for unemployment. If you have a smartphone and a bike, your income moves from 7,000 shillings a month to 30,000 shillings. So suddenly you have opportunity, which is a big issue for the youth. If you know, the average age of the country today is 17.6 years old. So we're only going to have more youth. In addition to that, it has revolutionized transport. As Mr. Moga has said, in the village in where I'm from, for example, we used to have this old pickup that you would have to wait if you wanted to move your maize to the posho mill. Today, you just have to call the boda guy. He comes. I don't even know how they do it. They
Wrap
put it
the
on,
thing.
and then it goes, and in 2 hours, everything's back. So I think I think it's going to revolutionize the urban centers and the unemployment for the youth.
and it's youth who have access to a mobile phone and they know how to use it.
Yes. So if we can help them de-risk, because my big thing in life is how do I help entrepreneurs make more money? So if I'm able to help them de-risk and make more money with these 2 resources, then we'll have a fantastic Kenya.
Asante sana. Kevin, we thank you very much for joining us this morning and all the conversation. There's a big conversation around digital literacy, which and also financial literacy, basically. People need to know those issues that you're talking about. Why am I being classified as a risky borrower? What do I need to do? When I borrow money, what do I need to do to make sure that I can repay so that I can improve my credit score as well, so that I can access better money next time? And I think now that you've plugged yourself, we can plug ourselves. This is a platform that you can use to do that, right?
Yes, and actually, I was going to say I love the studio. I think this is the best studio I've ever been to. So keep it up.
Asante sana.
Thank you very much.
We don't brag.
I'm not going to question that compliment.
Not that one.
I'm just going to breathe it in.
This is a physical manifestation that you've been looking for.
Yes,
Yes.
I have to see it, touch it,
And
for me to believe.
When you're told by Mr. Moneybags that he has been to many studios around the world and he has never seen one like this, believe it.
It's true.
Good morning.
This is the Situation Room, the only way to start your day.